on the hour. So I will welcome everybody formally to day 3 of the meeting. Obviously, we're midway through the revenue and transfer expenses item. Paul, if I can pass back to you to finish us off on item 4.2.2.
Yeah, thanks, Chair. We'd dealt with recommendation A, which was that the asset can exist where there's a where the transfer provider has paid cash or transferred other resources ahead of receiving, ahead of the transfer recipient fulfilling its obligations. So the second recommendation is that we then revise the accounting models to take account of that. The accounting models in ED 72 for transfer expenses with present obligations, i.e. those where there was an obligation on the transfer recipient, but not a performance obligation. ED 72 required recognition of an expense as soon as there was a transfer of resources in those cases. As the board has now agreed that there is an asset when the transfer provider transfers the resources ahead of the transfer recipient performing, that indicates that immediate recognition of an expense would not be appropriate, subject to all the discussions we had yesterday around measurement, etc. So in those cases, that would mean that the existing accounting model for transfer expenses with present obligations doesn't work for the board's current agreement on the asset, and so therefore we're just recommending that staff or the IPSASB agree that those models need to be reviewed, and that the detail of the models will also depend on the board's discussions later today in agenda item 4.2.4 on whether needs to be a distinction between transfer expenses with performance obligations and without performance obligations. So just looking for any comments on that, but it's really a consequence of the first recommendation.
Thanks, Paul. And obviously, I didn't want to force that discussion at the end of the session yesterday because I wanted members to have an opportunity to comment on that. So I will open up for comments at that point. Yeah, Camira.
Thanks, Chair. I do agree with this recommendation, and also because it's in line with what the respondents suggested or what they criticized on that. I'm just wondering what are our plans to address the issue of monitoring the completion of the present obligations, of the performance obligation, because it was quite an issue that many public sector entities say that, well, they are not able to continuously monitor this performance, and if maybe if this could be replaced by some kind of reporting or something similar. So thanks.
Paul, back on that.
Yes, I think that's right. We do need to look at the monitoring. We haven't got into any details at this stage because the monitoring arrangements will in part depend on the accounting models that are produced. But we are aware that respondents were critical of the level of detail of monitoring that was going to be required when there was a full performance obligation, public sector performance obligation approach being applied, because it was focused on the transfer recipient's perspective, and providers often wouldn't have that level of information. So I think what we will be doing is, once we've got board agreement for the models, we'll be looking at the monitoring arrangements in a way that is sufficient for the transfer provider to be able to demonstrate they still have control of an asset, that they are still, which would typically mean they're still able to enforce the agreement, and that they can confirm that the transfer recipient still has outstanding obligations, without necessarily having the level of detail of monitoring that was included in ED 72. So there will be a balance to make sure it's not too onerous, while at the same time that enough information is available to the transfer provider to be able to demonstrate the existence of the asset and that it can be measured reliably. So yeah, that's going to be a task for once we have sufficiently developed the models.
Thanks, Paul. So I'm not seeing other hands raised. Oh, Ross.
I just wanted to pass on the comments that I received this morning from Hervé Adrian in his absence, that he agreed with the recommendation in the paper, and to fully agree it's absolutely necessary to support the scope and the definition as proposed by Paul in the paper.
Thanks, Ross. And I think you've got some other comments you'll play in as appropriate from Adrian. So, I mean, I think with that, we agree with the recommendation. I think picking up Camira's point, it's going to be very important that we address the monitoring side, which would, I think, be based and would flow from the principles that we are agreeing now. And that we see a logical connection through the implementation of those principles through to the eventual disclosure, because that should be a consequence of monitoring and so on if expenditure is to be deferred. So there's a logic flow to all of this that I think we should look at from a principle top-down approach as we go through this. Lynn.
Yeah, it's not to come back on this paper, but I guess it's the sort of whole discussions that we had yesterday and today. Clearly, where we are likely to end up is very different to what we first exposed. And so I guess there's two observations on that. One, a need for a re-exposure, and secondly, a need to really explain in the basis of conclusions how we've moved our thinking and why. And that's going to take some work, I suspect.
Yeah, I mean, clearly any change in view as a result of constituents' comments will need to be explained in basis for conclusions. Ross, I just wonder if you can remind us on the process on decisions on re-exposure.
Yeah, thanks, Ian. So on re-exposure, the way our due process is set up is once we finalize the standards coming out of these 3 EDs, and the board votes to approve them, it then considers whether there's been a substantive change that merits re-exposure. And our due process sets out that consideration happens after the board's approved what it believes would make an appropriate final standard. Then they reconsider whether there's a vote for re-exposure. If the board chooses to have that vote on re-exposure, then it needs 2/3 of members to support re-exposure, the same as approving the standard itself. So that's the process we're planning to go through according to the current timetable next June. Obviously, when we're at that position and the board's looking to approve the standard, we'll have a paper on re-exposure from staff setting out the thoughts from a staff perspective on if re-exposure is needed or not, based on the facts of the various projects and what's changed. So we'll provide a summary of the changes from the exposure draft to the final standard and key things that have changed that help board members decide whether they think re-exposure is merited or not for the various new standards.
So thanks, Ross, for that reminder, because I think it is important that we bear that in mind. But that due process is very deliberately designed that way, so that that doesn't interfere with the board debates in the meantime in terms of getting to that proposed final standard. Okay, Lynn.
Yeah, so I guess I understand all that, and I'm not disputing all of that. I guess it's probably worth having almost an asterisk in the work programme, though, to potentially anticipate re-exposure if we are fundamentally changing the accounting model that we originally exposed, i.e. if we already know now that the change is substantive, then we probably ought to at least have some sort of flag in the overall work programme on that.
Ross, I think we'll leave that one with you to have a think about how we handle that. Okay, good. So I think that concludes that item then. So Paul, if you can move us on.
Thanks, Chair. Yeah, the next session is looking at the scope and definition of transfer expenses. ED 72 sought comments on several issues, and specific matter for comment 1 asked whether respondents agreed that the scope of the draft standard was clear, and if not, what changes to the scope or definition of transfer expenses would they make. Respondents raised 2 types of issues related to the clarity of the scope and definition of transfer expenses, which responded directly to the question asked in SMC 1. And secondly, they raised some disagreements with the proposed scope of ED 72. Staff have reviewed the comments and made proposals in the paper, and this recommendation, or this presentation, summarises the issues and sets out the staff recommendations. So the first issue is the definition of transfer expenses, which under ED 72 defined as an expense arising from a transaction other than taxes, in which an entity provides a good, service, or other asset to another entity, which may be an individual, without directly receiving any good, service, or other asset in return. There were, apart from the changes to scope proposals, which we'll look at later, there were no other real significant comments on this. So the recommendation is that the board accept this definition, that we retain that going forward. One of the query, or one of the disagreements with the scope that was raised was relating to taxes. We'll discuss that sorry, later in this session. If the board decided at that point to include taxes in the scope of the project, then obviously the phrase "other than taxes" would need to be removed here. But staff's not recommending the inclusion of taxes, and at this moment we're recommending retention of the current definition.
Thanks, Paul. So obviously there is a discussion on that specific reference to taxes that we have to hold until later. Can I take any other comments on that recommendation? Patricia.
Thank you. I agree with the recommendation, but I'm more about the provide service, because the discussion about the control of the assets can be different here. Maybe if probably when an entity provides service directly, in fact create an asset is in the moment, not retain the assets, the control the existing assets. My question here is, it's appropriate to use provide services, or if it's appropriate, I think it's necessary to clarify in which circumstance that the entity provides service. For third parties, I think it's indirectly, but my question is if the entity provide service directly, for example, the federal government for municipalities. In this case, how to treat the transaction. I think that there are different consequences in terms of the analysis about the control of assets.
Thanks, Patricia. So, Paul, if you can remind us about the thinking behind that.
Yeah, I mean, in most cases, we're going to be looking at the transfer provider providing cash. In some cases, they may be providing goods, but there is the possibility that they may provide services directly to another entity. So you may have, for example, a senior level of government providing some services directly to a lower level of government or to a not-for-profit organisation. So there are cases where they will provide legal services or payroll services to another entity. Now, if they're providing, say, payroll services to a not-for-profit organisation without being paid for it, so then there would be a transfer of services. That would be a transfer expense as we've defined it, because they're not receiving any payment for that. But in terms of whether you recognise an asset, if typically at that point there would be no obligations on the transfer recipient, so there would be no asset to recognise, because there would be no obligations on that the transfer recipient had to provide. Effectively, it wouldn't meet our definition of a binding arrangement, because there wouldn't be at least one present obligation on the transfer recipient. There may also be cases where you may be transferring those services to a third party as part of a wider obligation. So you maybe provide a not-for-profit organisation with payroll or legal services. They provide, in return, they provide services directly to the community. In that case, you would have a potential asset if you've delivered the payroll services, legal services before they have delivered the services to the community. So I don't think it's actually in substance any different to a transfer of cash. I do think it's going to be very unusual for there to be that sort of transfer of services that gives rise to an asset. I think in most cases where an entity is transferring services, it will be in circumstances where there is no binding arrangement and therefore no possibility of an asset.
Thanks for that, Paul. Okay. Lindy.
Thanks. Perhaps maybe I didn't understand, Patricia, sorry, but I thought we had the same concerns, because we're saying that you would have an asset which embodies service potential, and then what I struggle then, and maybe it's how we explain, is we're going to expense it as a transfer expense, meaning that we don't get any goods or services in return. So I think that just has to be explained, that there's something we control, but when we expense it as a transfer expense, it's a transfer, we don't get anything in return. And I guess that's where I'm also still trying to struggle the link between, the reason for having the asset. Thanks.
So it does seem that we need some additional explanation, really, to address both your point, Lindy, and to ensure that we've adequately got the explanation which addresses Patricia's thinking. Patricia, are you okay with that as the way forward, that we make that explanation?
Yes, it's yes, and I used my notes for Paul too.
Okay, so Paul, if you can work with Lindy and Patricia just to make sure that we add the necessary explanation, and I think we just need to think about where that sits best, in terms of whether it's some form of guidance or whether it's basis for conclusions. Okay, so if you can move us on then to the next recommendation.
So the next block of recommendations are those that related to.
Sorry, Brienne, you wanted to come in.
Yes, please. I had thought we were still on the issue of tax excluding taxes.
We can come back to that one later.
Okay, fine. That's what I thought. Thank you.
Okay, thanks. Paul.
So the first set of comments from respondents related to the clarity of the scope of the transfer expenses standard. And so we're going to look at those. So there were 4 areas where they were raised, mainly to do with the relationship with other standards. I think the definition was considered to be clear, but respondents had concerns over the relationship of ED 72 with other standards, and that includes ED 1771. So there was particular concern around IPSAS 19, onerous contracts being one issue, IPSAS 42, then other IPSAS including ED 70 and 71. And then there were a number of other issues raised which staff are recommending we look at future meetings because they're not directly related to the scope in staff's view. So the first issue relates to the clarity of the relationship with ED 72 and IPSAS 19. The main concern here was that that respondents considered that IPSAS 19 is effectively a residual standard picking up issues that are not addressed in other standards. The drafting of ED 72 implied that may also be a residual standard, so there was conflict between the fact that both standards were drafted as residual standards. So the staff recommendation is that we address that by effectively being prescriptive in ED 72 about what the accounting treatments are and leaving IPSAS 19 as the residual standard. So if it's going to be covered by IPSAS 72, then ED 72, then ED 72 has, or the IPSAS based on ED 72 will have the final, have the detailed accounting requirements, and you would only go to IPSAS 19 for something that is not within the scope of ED 72. And we propose to do that by removing the scope exclusions in the proposed transfer expenses IPSAS relating to IPSAS 19, so that we're not trying to manage that boundary. We add a scope exclusion in IPSAS 19 related to transfer expenses. And we include additional guidance in the proposed transfer expenses IPSAS to distinguish transfer expenses from collective and individual services, which is where most of the confusion was arising. So that's the first recommendation. I'm looking for comments.
Todd.
Thanks, Ian. I just want to be clear. So if we're putting a scope exclusion into IPSAS 19 and say it excludes ED 72, we're going to do that in a way that we can apply some of the things in IPSAS 19 if they're not covered in 72. Is that what I heard you say? Because if we don't craft it in that way, there may be other things in 19 that we need to think about dealing with in ED 72. So I just want to be clear on that.
Yeah, I think the drafting says it excludes transfer expenses as defined in ED 72. So I think the intention is very much that if it's within the scope of ED 72 and you're applying ED 72, then you don't need to go to IPSAS 19. If it's not within the scope of ED 72, so you're not applying ED 72, then yes, unless there's another standard addressing it, you would be applying IPSAS 19.
We're picking up the onerous contracts.
There's a separate,
we're thinking about that in terms of ED 72, the onerous contract, which is sitting in 19.
Yeah, there's a separate recommendation addressing addressing onerous contracts, how we're proposing to deal with that, and also at the I think it's one of the agenda papers with the draft. So at the end of this paper, we have the draft amendments that are proposed to ED 72, which includes wording around onerous contracts.
So I suppose my question then is there anything else in 19? So we've got onerous contracts in 19. Is there anything else in 19 that we're going to need to address in ED 72 as a result of having the scope exclusion in 19, excluding 72?
I think the only thing I could think of was it's possible that an entity might need to raise a provision if, for example, it had made the statements that it was going to enter in. If you had effectively a non-legally binding obligation arising out of statements and commitments the government had made ahead of it entering into transfer expenses with into a binding arrangements with particular entities, it may give rise to a provision at that point. But I think it's not going to be, it's going to be relatively unusual. But I think potentially you could have a circumstance where a government commits itself to a non-legally binding obligation, giving rise to a provision before there's been any binding arrangements entered into, which would give rise to a transfer expense. So that's the only thing I could think of.
Okay, thanks for that explanation, Paul. So I'm not, oh, Mike.
Thank you, Chair. I think the conversation you just had between Paul and Todd suggests to me that the decision to do what we're doing needs to be very clear in the BCs, so that people are directed where they've got to go.
Yeah, I think that's right. Okay. Good, thanks. So I think we agree that recommendation then, Paul. So move us on.
So second recommendation is that is around the onerous contracts. Arguably, any transfer expense could be an onerous contract because you're providing resources, typically cash, without receiving anything in return. There was a similar situation that the IPSASB had addressed in IPSAS 11, where which is construction contracts. So if you entered into a construction contract to build an asset for a third party, and that contract did not give you at least recovery of costs or profit, but either meant you were subsidizing it because you were building the asset at below cost, or perhaps for no cost recovery at all, there was no payment. Then under IPSAS 11, that was not an onerous contract because the intention was always to provide that subsidy, which was seen as a government, effectively an ongoing government activity. Staff think that that's an appropriate treatment for transfer expenses, that you would not treat binding arrangement for transfer expense as an onerous contract at inception. Because the intention is always to provide a subsidy. We think there may be cases where there is, the contracts could become onerous. So for example, if you are paying transfer recipient to deliver goods or services to third parties, and the circumstances change such that the amount you are paying for those goods or services exceeds the fair value of those goods or services, then we think at that point the binding arrangement may have become onerous. But what we're proposing is that we deal with those circumstances directly within ED 72, rather than referring back to IPSAS 19. And again, that was the approach that was taken in IPSAS 11, that where you had these onerous contracts under IPSAS 11, then it was dealt with within IPSAS 11 rather than by reference to IPSAS 19. So we're proposing to continue that approach to onerous contracts by dealing with it directly in IPSAS, or in the IPSAS based on ED 72, but in limited circumstances, because when you enter into a transfer expense binding arrangement, we wouldn't treat that as onerous when you enter into it, because the intention is always to provide a subsidy.
Thanks, Paul. Patricia.
Yes, thank you. I have two questions here. In the first is in relation to not have honest contract in inception. I think that is because in deception, the considering the definition of executory contracts, in the inception, the contracts can be favorable or unfavorable. The contract can determine penalties. Then I think that is the possibility, and IS 37 indicate this possibility too, because for defining if a contract is onerous or not, it's necessary to compare the cost of the contract and the benefits of the contract. The cost is the lower of the cost fulfill the contract or any compensation or penalties from the failure to fulfill. Because this in the inception, if the contract has penalties, the contract is onerous, because if the entity decides not to fulfill, it pay penalties, or it have to return the money. Not to return the money, no, but in specific case, the penalties. Because this, I think, in the inception, the contract can may be onerous. Another question that I have, I think about is considering the scope of the transfer expense, and in accordance with co-present yesterday, there are two groups of object of the contract or the binder arrangement. The first one is transfer goods or services for third party, and other kinds of goals or kinds of requirements related to the potential services. And in my view, the two groups are related to the achieving the objective of the entity, consequently related to the service potential. In this case, it's appropriate to use fair value, because when I discuss about the considering the measuring project, or when I measure some assets, I need to consider the for what the assets is held. Then my suggestion is to review if the fair value is appropriate. But I think it's more complex, because in fact the logic or the rationale is compare the cost and benefits. When I think about the economic benefits, okay, it's I compare the cost fulfilling the contract or assume the penalties, and it's in the case of the penalties, it's because I don't have the benefits, I only have the cost. In this section, for example, I only have the cost, not have the benefits, because the another part and doesn't fulfill the each obligation. But after the inception, when one of a part fulfill the obligation, I can think about the cost and benefits. In this case, benefits measure the benefits of achieving the objective of the entity is outside of the scope of the IPSAS. Because this, I think we need to think more carefully about these how to consider in the context of the transfer expense, considering this scope. But I think it's necessary to think about the revenue too, transfer revenue too.
So, Patricia, I think we need to be very careful not to overcomplicate this and overthink this. I think if you look at the point about inception, there's a difference between what happens when you first recognize in year, this is a bookkeeping question, and what happens when you prepare the accounts at the year end. And I think that's one of the things that needs to be thought through. This is a bit like we had with the property, plant and equipment, initial recognition, and that kind of question. So I think we need to be very careful about what is inception, i.e. when you enter into a transaction, and what actually appears when you look at financial statements at the end of that first year. Secondly, I think on the measurement side, yes, there are some issues that we need to think about, but equally in these contexts, you know, we've already got guidance which we're preparing in ED 78, where it's an existing asset that you would de-recognise. It's not a market situation that would be dealt with under ED 79 at that point in time. And then this is unlikely to be a service that's actually provided in the market then when you look at the asset afterwards. So I think we just need to be very careful to use the other guidance that we've got by analogy and not overcomplicate this. Paul, anything you'd like to react to in terms of what I've said?
Yeah, I mean, I think one of the key issues is the fact that this is the government giving or making transfer expenses, i.e. giving cash or other resources to other entities, perhaps individuals, without receiving anything directly in return. Yes, it's doing this to meet its objectives, but arguably it's going to be very difficult to assess on each occasion whether or not how you would actually measure exactly what that benefit is, particularly if you're providing, you're paying a transfer recipient to deliver vaccines, for example. How do you assess what the benefit to the organization is? I think that would be difficult. I think it's also worth noting that the onerous contracts provisions are written essentially around the basis or linked, they drafted with a view towards revenue recognition. So you're entering into a contract which will earn you revenue. If the costs of providing that, the goods and services that will earn you the revenue exceed the amount of revenue you're going to receive, then you recognize a liability because the contract has become onerous. It's going to cost you more to deliver the goods or services than you are going to generate in revenue. That's not the circumstances we're looking at in a transfer expense, where you are giving the resources away as a matter of government policy without receiving anything in return. So I think it's a different set of economic circumstances that we're looking at. And I think the strict application of the onerous contract provisions in IPSAS 19 wouldn't therefore be appropriate. But I do agree that if you're entering into a contract with a transfer or a binding arrangement with a transfer recipient to provide goods and services, and you enter into that binding arrangement initially at a market value, circumstances change and your contract now means you're going to be paying above market value, then I think in that circumstance, yes, it would be appropriate to recognize an onerous contract or an onerous binding arrangement in those circumstances, because you're paying above fair value, above market value for something that you intended to pay market value for. Other than that, I think it's it's a reflection of the nature of the transaction, that it's a transfer expense without the government receiving anything back in return, means that we don't need to recognise any liabilities for those ongoing activities of government, as IPSAS 19 says, are treated as not giving rise to a liability, and these are seen in staff's view as effectively ongoing activities of government.
Thanks, Paul. I'll just go to Lynn at this point, and then Linda.
So I worry that we are making an assumption that government never makes a bad binding arrangements in deciding what subsidy it's going to provide, and I think we're being too simplistic in assuming that the transfer expense level equates to achievement of service potential. There could be, and I think that, I guess I'm on the same place as Patricia, that we perhaps need to do more work to say what could be a onerous binding arrangement when it comes to service potential. So an assumption that we will never have one at inception, to my mind, I don't feel absolutely comfortable with without seeing some more analysis, because intuitively I think it could be possible to have a onerous binding arrangement where we are paying more subsidy than anyone could ever say was justified in the circumstance, and we're not allowing for a situation where a government makes a bad decision and accounts properly for a bad decision, where we might be over subsidizing. So I think I think we should open up the possibility of an onerous contract at inception on service potential, and I'd like to see some more analysis on this.
Sorry, can we just be clear what we mean by inception here? Because there is the point that you would actually account for the contract on day one during the year when you enter into it. Now, then there is certainly a process, and I would agree with you, Lynn, that you would then need to review and say, actually, having signed the contract, actually, have we not got value for the assets? But that is at the year end when I prepare my accounts. So I think we need to be very, very careful here about what is day one in the year versus what is actually we look at when we look at the accounts at the end of the year. And I agree with you that there is a possibility that government will enter into a bad agreement. But on day one, when I sign my contract as a government, either I'm transferring cash or I'm transferring an asset, and I would make an agreement that I'm transferring that asset at a certain amount. Either it's book value, or if I'm transferring below value, then yes, I would need to record a transaction, and maybe that is what we're talking about in this case. So I think there's a day one, what do you actually recognise at that point, and then there's the process that you go through at the end of the year. Now, I think we need to be very careful not to overcomplicate this in terms of those different stages. Lynn, you want to come back on that?
Yeah, I think we also need to be very careful not to oversimplify and make an assumption that you're always getting value for your transfer in service potential terms, both at inception and at the year end. And from the conversation, I was concerned that there is an assumption being made that is too simplistic, that assumes you are always getting value for your service potential. And I don't agree that you would always necessarily be in that case, both at inception and at the year end.
So if we summarise it, that when you record this in your books, actually what you need to look at is the value that you've entered into versus the value in your books for any asset that you transfer other than cash. That's one point. And then when you come to prepare your accounts at the end of the year, then you would look and say, actually, is there anything else that would indicate that I need to record a further impairment or whatever because I've overpaid? So there are two stages in this. So Paul, I think if you can be clear about what the two stages would be, I think that would help settle us on this, because I think we need to actually think practically what would happen in terms of how I would account for this in my bookkeeping during the year, and then what would happen when I actually do my bookkeeping at the end of the year. And that would actually account for the fact that I might deliberately decide to put an asset in at below value as part of the transfer agreement. So I think that would be, potentially either I deliberately do it or I accidentally do it. And then I have another look at it again at the end of the year. So can we, actually ask you just to be clear for members? And I think this does mean that we do need to come back to that, but actually, can you be clear in terms of, let's not dress all this up as onerous contracts. Let's actually have a look at it and say what would happen in those two situations, and then we can work out what the guidance would actually be in the standard developed from ED 72. Okay, so I think we need that anyway. So can I then have reactions to, is that a reasonable way forward on this? So I'm going to go to Lindy and then Mike.
Thank you. And I was just looking at the wording in Appendix 3, because to me it looks like this is a subsequent measurement of the prepayment, if you call it, the asset that we've recognized. And then you would kind of measure that and look at, well, is some of that overstated, and then recognize a loss at that point in time. My only caution was, I guess it depends on the model, because would you have this information and how readily available for you to determine that? But I think that depends on how the model is going to be designed, because I wouldn't want us to make this very complicated, that you need to have these figures readily available in order for you to make this assessment at the reporting date. I also just questioned, then we're saying that you would expense, the difference between the fair value, a portion of the asset that you recognize, but you would then also expense value of the resources to be transferred in excess. So you recognize, so there's part of it is like an impairment test, and part of it is then assessing the contract as onerous and recognizing a loss then as well. Because that I got a bit confused.
Thanks, Lindy. So I think come back and have a look at that when we see the drafting on those two stages. Day one, when I sign the contract, and what I would do when I prepare my accounts, because I think that practically would address the situation that you're talking about. And I think we're saying that the guidance on this will need to be in ED 72 rather than cross-referencing back to IPSAS 19, which was, so that the guidance will need to be in this standard. Mike, then Bernard.
Thanks, Chair. So I agree with your response to Lynn that this needs to be really, really clear. And I'm assuming that we're talking about circumstances where the resource provider provides an asset where there is a performance obligation, because if there is no performance obligation, then it's going to be expensed anyway from day one. Okay, so you're nodding. Thanks, Paul. So then my other point was, I'm trying to get my head around, we're now going to have onerous contracts, if I heard you right, Paul, in two standards. Is that right? In ED 72 potentially, and something in ED 19. And again, to help preparers, we just need to be able to help them navigate where they've got to go when this circumstance arises.
I think it might be helpful not to use the term onerous contracts here, but just actually say this is part of the process, and then we're not going to get confused on the use of the term, because as Paul said, clearly this is an issue on the revenue side, but we're on the expense side, and probably from a preparer point of view, it's more useful to give them guidance on what you do on day one and then what you do at the end of the year when you prepare your account. So I think if we don't use the term onerous contracts in this context, that should help our constituents. Bernard.
Thanks. I just wanted to agree on the point. In my mind, it really is also about subsequent measurement, and I think we have to really think through the whole flow of the transaction, because information available can change over time, right? So even if I have at the beginning of the transaction a certain information at hand or a certain intention in mind, this might change over time, so we have to reflect that anyways. I mean, I'm intrigued by your point, Lynn, that yeah, you're not always getting your bang for the buck. that's absolutely the case. And what I struggled a bit is in conceptually, because I thought that we would associate the potential asset to be recognized with the amount of funds to be transferred. So once you spent that and you overspent, actually, you have the whole expense in your books. So I wouldn't see actually how we would add on to that. So to me, always it was a bit on proper accounting for those transactions, and then you have a basis for your performance audit, where you can come in with opportunity cost and different ways of providing the service. But I would agree. I mean, I think we are really very, very deep in details now, and rightfully so. But at the same time, I think it's important to not miss the forest for the trees, because this is groundbreaking work. We're talking about the biggest gap in our literature, and given that there wasn't any harmonized guidance on how to account for transfers, the practice is all over the place. And I would expect, to be honest, the points of friction between whatever guidance we put out there and the current practices of governments be quite significant. So I just wanted to make the case that actually we are really doing a very, very important work here, and we're not going to make it perfect. I acknowledge that. Doesn't mean we shouldn't strive for the best version we can accomplish, but we have a huge gap in the literature on that. And just talking from practice, we used even the exposure draft material for one of our regional governments, which moved from cash to accrual accounting to help them assess their transfers. And basically, I mean, it's anecdotal. I totally acknowledge that. We had a couple 40 transactions to evaluate, but we had basically 3 buckets. Those who have very, very detailed performance agreements, which very, very nicely run through the flow of the transaction, and then we had those who barely have been half a page, and also with them it was very, very clear. You don't have any enforceability with that, so the money is gone. You have your expense into the account, and then you have the gray area. And I think that's what we're talking about. We're talking about the gray parts of those transactions, and this is incredibly important. But again, I think we shouldn't miss, the holistic perspective of what we are talking about. Thanks.
Thanks, Bernard. I think that's helpful to relate it to real life experience. Thomas, final word, and then I think we move on.
Yeah, thanks. It was not my intention to have the final word, but I just want to share an observation. When I listen to your discussion, I think you have to be careful not only to confuse kind of the use of the word honest contract, but also the use of the word asset. Some of you are talking about transfer of an asset, and others are talking about the asset resulting from the right to receive or to get the fulfillment of the obligations. These are totally different assets you're talking about, and you should be careful that you're not mixing it, because I think what you're talking about, and this was one of the tasks and the issues the CAG was also concerned about, is, first of all, if you recognize an asset, and this is, as you talked about, Ian, day one, if you recognize an asset from the right to receive the fulfillment of the obligations, what happens after with this asset at the balance sheet date? When you evaluate the service potential you get back and you gain from the fulfillment of the performance obligations or the obligations, do you have an impairment need? And this is dealing with this asset which is derived from the right. That's completely different from transfer of an asset, which happens before. So just be careful that you're not mixing what asset are you talking about.
Thanks, Thomas. And I think that does underline we need to be very careful about what we need to fix in this standard and what is actually already covered by other standards that we have. So as not to confuse. But I think one thing that does come out clearly from this is that we should not use the term onerous contract here. We should actually provide the approach and the process and the thinking about how you should handle it. rather than using that term. Okay, so Paul, I think, are you clear on the additional analysis that needs to be done in terms of what needs to go into this standard?
Yeah, I think so. And going back to the terminology, talked about onerous contracts here because that's the term the respondents used, the term that's used in IPSAS 19. The proposed drafting talks about recognition of expected deficits, which is the term that was used in IPSAS 11 as well. So we're not talking about onerous contracts in the proposed drafting for ED 72.
Thanks, Paul. I think that's helpful. Okay, so move us on then to the next recommendation.
The next issue was around social benefits, distinguishing transfer expenses from social benefits. And the recommendation is that we include additional guidance to distinguish transfer expenses from social benefits as application guidance in the draft standard.
Okay, open for comments. No, I think we're content with that recommendation. So move to Paul.
Moving on to the other standards where there was concerns around the interaction of IPSAS or other IPSAS and ED 72, staff are proposing that we update the list of items excluded from the scope of the proposed IPSAS to include service concession arrangements and transactions with owners. I think with service concession arrangements, it's unlikely that there would be a conflict because generally with service concession arrangements, the entity would receive something in return. But given it was raised as an issue by a number of respondents, it may just be sensible to put the exclusion in there to make sure that we haven't missed any circumstances where there could be a potential conflict.
Thanks, Paul. Not seeing any hands raised, so I think we're content with that recommendation. Okay, so move us on then to the next one.
Then, as a result, looking at the transactions with owners, there was guidance provided in ED 72 as to why transactions with owners are not transfer expenses. A number of respondents commented that actually that wasn't standards level guidance. That was much more of a basis for conclusions text. Staff agrees with those comments, and we're proposing moving that explanation into the basis for conclusions.
Okay, any comments on that? No, I think we're fine with that recommendation. Thanks, Paul. So move us on.
This next recommendation, I think, is linked to some of the discussions that have been had with conceptual framework. Some of the respondents expressed concerns about potential confusion between the term transfer expenses while there was a general use of the term transfers. And I think that particularly relates to the fact that transfers was also a defined term in IPSAS 23. So we're proposing including additional text within the basis for conclusions that explains the use of that. And I think obviously if given the discussions on the conceptual framework yesterday, and the discussion around the use of transfer resources, we may need to look at that text again, but I think it does need to be explained that transfer expenses is a specific term, transfers is a general term, just to give that clarity to readers.
Okay, thanks, Paul. Not seeing any comments, so I think we're okay with that. So move us on to the next recommendation.
There were a number of other minor issues identified by respondents. which were raised in the context of the scope of the IPSAS, sorry, ED 72, which staff consider are better addressed at a later date. Staff doesn't really think they're particularly scope related. So there was relationship with ED 70 and 71, particularly around consistency of definitions and terminology. We've looked at some of the definitions and we will need to sort of review those, bring in the definitions into ED 72 that are currently in ED 70 and 71 as the board has agreed. But we have agreed that we will need to do a full review of all the terminology across the currently three draft standards to make sure that everything is consistent and everything is sorted once the drafting is complete. Treatment of overheads was raised as an issue with scope. Staff think that that's actually a measurement issue, so we're proposing to address that. Want to look at recognition and measurement in the accounting models, and similarly services in kind was raised. And again, while staff think it's clear that it is included in the scope, we will need to perhaps provide additional guidance in the recognition and measurement sections, which again will be developed as we develop the accounting models. So at this stage, we're not proposing any action on those issues.
Thanks, Paul. Helpful to understand what you had in mind there. And obviously, we'll pick those up on a case-by-case basis.
Yeah.
Okay, I think we're content with that. So move us on.
So the next group of comments from respondents relates to issues where they considered the scope was incorrect and we should be changing the scope. The first one was around taxes. A number of respondents commented that taxes should be included. Other comments were that we should exclude subsequent measurement of non-contractual payments. So while we don't address non-contractual payments, and again, those were particularly tax related, we don't address those within ED 72. We do address the subsequent measurement of those non-contractual payables. There was a view from respondents that if we were excluding taxes from the scope of the standard, then we shouldn't include that subsequent measurement either. And then two sort of differing views on the overall scope of the project. Some saying we should include all non-exchange transactions, which we don't include at the moment. So for example, transfer expenses are those transfers where you don't receive anything in return. If you were to receive something in return, but at a lower value than the resources you're transferring, that's currently outside the scope. Some respondents considered we should include those. Other respondents actually considered that we should exclude what they termed commercial transactions, i.e. anything where you're transacting at market value. So if you're paying a transfer recipient to deliver vaccines to the population and that transaction is at market value, they propose that you should exclude those. So if we can move on to the individual recommendations. The first recommendations is that we do not include taxes within the scope of the proposed transfer expenses IPSAS. Staff's view is that actually the recognition of taxes is more closely aligned with recognition of a liability is proposed as covered by IPSAS 19. And if we look at the situation with IFRS, there is an IFRIC 21 on levies, which would address many of the tax issues. It's consistent actually with the past event for recognizing a liability for taxes under IFRIC 21 is consistent with IPSAS 23 and ED 71's taxable event, but it's it seems to be more about the recognition of a provision. IFRIC 21 is based on IAS 37, which is the provision standard in IFRS. So we think that it may be appropriate at some point to consider an improvements or narrow scope amendment project to add guidance on tax liabilities to IPSAS 19. I think it would probably make sense to not do that at the moment until transfer expenses, revenue, conceptual framework, measurement have all been addressed. But at some, we think that that's probably a better fit for the guidance on taxes than ED 72. And that's consistent with the board's view in developing ED 72.
Thanks, Paul. So open up for comments on that recommendation. Adrienne, I was waiting for your hand to come up.
Well, it's really a question to the rest of the board and the staff. I was struck by the commentator who raised the problem of non-recoverable VAT becoming a transfer expense, and I thought that that could be a real issue that affects a lot of entities. So I want to understand the scope of the problem that we're creating by excluding non-recoverable VAT. Is this going to be a real issue for practitioners? In the IMF, we emphasize all the time that the flow of the VAT, the accounting for the VAT should be unbroken, and whether it goes in and out of the public sector, there shouldn't be different accounting. And when it becomes recoverable, to switch from to turn that into accounting under a different standard, does this create a serious inconsistency in the VAT accounting? So it's a question, because I'm not an expert on this, but I would like to hear if other people see this as an issue. Thank you.
Paul, can I go to you, please? Because I think this actually comes into what is actually the cost that falls on the entity. Paul?
Yeah. So I think typically this would arise where government is making a transfer to either a lower level of government or another third party to perhaps deliver services. That entity incurs VAT on delivering those services, which it's not able to recover. Now, if the transfer to that government covers that non-recoverable VAT, then from the perspective of the government making the transfer, it's not a tax for that government. What it is part of the transfer expense. So it would just be a cost of the transfer expense. It's making a transfer to the entity delivering the services. That entity's costs include some recoverable VAT, but from what ED 72 would be covering is the transfer being made by the government to that entity. It's not covering that entity's costs. Those would be dealt with elsewhere. So in terms of the government transferring transferring funds to that entity, it would be a question of what's in the binding arrangement. But if the binding arrangement is we will cover all of your costs, including any irrecoverable VAT, then it's simply a part of the cost of the transfer expense. So it would be included in the government's expenditure. It wouldn't be a tax expenditure, wouldn't be classed as a tax because it isn't a tax for the government. It's a tax for the entity that's delivering the services. So I don't think it's going to cause any problems in terms of irrecoverable VAT for the governments or the entities that are making the transfers, because it's not their tax.
So, Paul, I think, I saw nods when you were making that explanation, and I think it clearly is an issue that we need to pick up and make sure it's absolutely crystal clear for the reasons that Adrienne explained. So if you can take that as away as an instruction that we need to provide further clarification wherever that's appropriate.
Yeah, I think it's similar to the issue that was raised earlier around overheads, I think we do need to give more guidance around the nature of the costs that are included in a transfer expense. So yes, we would need to provide guidance on overheads and what's included in the cost of a transfer expense around overheads. And similarly, I think mention of irrecoverable VAT would also be part of that explanation of cost.
Okay, thanks for that, Paul. Okay, good. So move on then to Bernard.
Thanks. I'm fine with the scope as is, to be honest. I think Paul's explanation firstly indicated there is some guidance around some of those tax transactions. And at the same time, I think it's a very broad field. So we could talk about intergovernmental transfers, which might be perfectly in line because they might not have any obligations in return. But we also might talk about what we discussed during the consultation of the work program when we talked about tax expenditures. So you might bring in a whole bunch of different types of transactions you could associate to taxes. And quite frankly, I feel that the scope we are currently having is fine, and I don't feel very comfortable kind of bringing in a whole bunch of types of transactions we might not be able to define at this point in time.
Thanks, Bernard. Camilla?
Thanks, Chair. I just have a clarification question. What will happen with those tax liabilities, or let's say that by law, there is a central government entity that has to transfer a certain percentage of the tax collected to another entity, a municipality, let's say. Is that, will be that within the scope of this ED 72, or that will be out of the scope? And if it's out of the scope, which standard will the entities use? And I think it will be also good, at least if it will not be within the scope of ED 72, at least to consider in a future project or from our work program, also to offer guidance on how to account for tax expenditures and also the payments through the tax system, that those are terms and concepts that are covered in IPSAS 23 right now, but also to have the counterpart, because that will be a remaining gap then in the literature. Thanks.
Yeah, I think in most cases where a government is collecting tax with a requirement to pay a certain percentage over to another entity, in many cases it's acting as an agent. So the tax is 50% for central government, 25% for the regional governments, 25% for local governments. Effectively, it's an agency arrangement. So it would be outside the scope of ED 72 because it's not a transfer in the sense of the government transferring its own cash. It's simply collecting tax and transferring it under an agency arrangement. If it's collecting tax and then chooses to transfer without a legal requirement to do so, then at that point it's not a tax issue. It's a choice that the entity is making. So it would just be a normal transfer at that point.
And I think on the tax expenditures and so on, we've got guidance on that already in terms of how that's dealt with. It's either a benefit or it's dealt with in currently IPSAS 23 or what will be the new revenue standard. Mari, then Adrienne.
Thank you. From my point of view, this discussion depends on how we define the tax expense. And so the definition of the tax expense is very important from my point of view. Thank you.
Thanks, Mari. I mean, I think that's an issue for IPSAS 23. It's not an issue for this piece of work. Adrienne.
So I really like Paul's comment about the percentage transfers being an agency issue. I wonder if there's any way that somehow, it's not very obvious how, if that point could be included in the guidance. It makes perfect sense to me, but I'm not sure that other people will understand that unless we make it explicit.
But Adrienne, it is explicit in IPSAS 23. So I think, have a look at it when we are looking at that standard, the standard that will be developed from ED 71 and see whether it's explicit, because it's covered there, it's not here.
So, but it's Camara's question, which I thought was a very good question, and I think it will.
Yeah, but look, it's covered elsewhere. It's not in this project. That's the point. So if you go back to the scope of this, it's outside the scope of this. And what Paul clarified is that it's dealt with in terms of principal agent, which is covered in the revenue standard, not transfer expenses.
Okay, sorry. Yeah, fine.
Okay, Lindy.
Thank you. So I agree that the standard should be limited to transfer expenses out of binding arrangements as a way defined, and any other types of transfer expenses we can decide at a later stage where we want to deal with. So, for example, a department that pays property taxes every month as part of their rates and taxes, or municipal services, it is a transfer expense, but I don't think we should include it in this ED at this point in time, because we're only dealing with binding arrangements, and that's not in terms of a binding arrangement the way we've defined it. Thanks.
Fall back on that, because I think when we do deal with transactions not subject to a binding arrangement here.
We do. If you were to donate an asset without a binding arrangement, or you to give cash without a binding arrangement. So intergovernmental transfers, central government transferring funds to regional government or a local government without any binding arrangement, just a straight transfer, no obligations on the recipient government, they are covered. I think it's a relatively small, so it's a relatively large amount of the transactions, and a significant in terms of the volume of the transactions. In terms of the volume of the material we're looking at, it's very small, because it's pretty obvious and clear that you recognize an expense immediately on transfer. So it's straightforward and doesn't take up much of the text, but it is going to be significant in terms of the volume of transactions that governments have.
Okay. So I think with that, we confirm the recommendation that you've made, Paul. So move us on to the next recommendation.
Next recommendation, two recommendations, relate to the subsequent measurement of non-contractual payables. They were included in ED 72 because they were homeless effectively. It was originally proposed as part of IPSAS 41, then was suggested as part of the public sector specific financial instruments project, then suggested as part of ED 72. I think staff's view is that we do agree that it doesn't make sense to include that subsequent measurement of non-contractual payables, typically taxes, within ED 72 if we're not going to not addressing the main tax payments there. And since the decision to, on location of that guidance was prepared, public sector specific financial instruments guidance has been completed and issued, and the approach taken in that was to include guidance in IPSAS 41, non-authoritative guidance that addresses, in the case of monetary gold, it says, is this there's guidance there which says, is this a financial instrument? No, but because it has similarities to financial instruments, you could treat it in the same way. So we're proposing that we actually adopt the same approach for non-contractual payables. So question that says, are non-contractual payables financial instruments? No, but because they have many similarities, apart from the fact they don't arise from contracts, you can apply the principles in IPSAS 41 in their measurement. So the recommendation is that we take it out of ED 72 and include that additional guidance in IPSAS 41.
Thanks, Paul. Not seeing any hands up, so I think we're content with those recommendations. So it finally finds a home. Okay, so move us on then, Paul, to the final recommendation.
And then dealing with the suggestion that we expand the scope to include all non-expense transactions or contracted to exclude commercial transactions. Staff are recommending that we make no further amendments to the scope of the IPSAS. The board went through this in great detail. In developing ED 72, there was a clear decision to align the scope with transfers as defined in GFS, and staff doesn't think there's been anything raised by respondents that the board hasn't already considered.
Okay, thanks, Paul. Consent for that final recommendation. Yep, okay, so I think we agree that recommendation. So, Paul, I think bearing in mind, oh, okay, no.
Yeah, so we have provided the draft text for on these recommendations in Appendix 3. If there's an issue of principle where the board has agreed to principle and but members think the text doesn't reflect that principle, please, happy to discuss that now. But otherwise, if it's editorial comments or improved drafting, and obviously in terms of the onerous contract material, we'll have to look at that again anyhow. But unless there's an issue of principle that we need to discuss, could you just let us have those comments offline, and then we can address those in finalising the drafting of the text.
Thanks, Paul. Okay, so I think we're good with that. So I think at that point, we're through that item, Paul. So I think now makes sense that we take a break. So I think I'm going to propose that we take a 15-minute break at this stage. So back at 25 to whatever hour you're on, and David, as per usual, will keep time. Okay, so thanks, Paul, thanks everyone, and see you soon.
1 minute.
Okay, so welcome back, everyone. So we now move on to item 4.2.4, and I think, Eileen, we're over to you for this item.
Thank you, Ian. So in April of this year, the IPSASB first considered a summary of principal-related issues raised by the ED72 respondents, and one of the significant issues relates to the distinction between transfer expenses with performance obligations and transfer expenses without performance obligations. And we brought this item to the KEG in June and have received a lot of useful member advice. Now, ED72 required a transfer provider, i.e. the entity actually applying this proposed standard, to identify present obligations and performance obligations from the transfer recipient's perspective. In the slides today, we're going to first present a quick summary of what is proposed in ED72, and just to illustrate how this distinction is actually integral because it leads to different accounting, we're going to outline some of the key constituent comments regarding the issue and their implications and bring in the KEG feedback. And lastly, we're going to propose a recommendation for member discussion. So at a high level, at inception, the transfer provider must complete a detailed analysis to determine if they have entered a binding arrangement. If they have entered a binding arrangement with the transfer recipient and potentially any other parties, then they have to then determine, does that transfer provider actually have a performance obligation? The results of this analysis would then dictate which accounting model the transfer provider would actually apply. So if the transfer recipient in this binding arrangement actually has performance obligations, then the transfer provider would actually have to apply the PSPOA model, where the transfer expenses would be recognized when or as the transfer recipient satisfies the performance obligation by transferring a good or service to a third-party beneficiary. However, if the transfer provider determines that the transfer recipient does not have a performance obligation, then the other accounting model would apply to account for the transfer expense, in which case they would recognize that the earlier of when the transfer provider has an obligation to transfer the resources and when the transfer provider transfers the resources. Now, stepping back, then this means that a significant emphasis is placed on the transfer provider's correct analysis and identification of whether the counterparty in the transaction, i.e. the transfer recipient, has a performance obligation arising from the binding arrangement. Now, staff have considered, the IPSASB requested feedback from constituents on this distinction, and a little over half had agreed, generally on the basis of consistency with the distinction that's provided in revenue, but 25% disagreed, and for several different reasons that we wanted to highlight today. So based on staff's analysis, we pinpointed 4 key issues that the constituents noted. The first being that there's no economic difference for the transfer provider, and therefore it would not really be relevant. Instead, constituents noted that the accounting guidance should instead assist transfer providers in determining whether they still have an unsatisfied obligation themselves, and in cases where they have begun satisfying their obligation, whether they still retain the control of the asset. The second key response was about this proposed accounting not properly reflecting the transactions themselves. So the current distinction proposed, which leads to separate accounting requirements for transfer expenses, may not faithfully represent the substance of underlying transactions for the transfer provider, and therefore not reflect the economic reality of transfer expenses in the public sector, where a majority of transactions are going to be without performance obligations. For example, the immediate recognition of transfer expenses in cases where the transfer provider has transferred resources but still retains control would not appropriately reflect the transaction itself. The third group of issues noted by constituents that we found useful to highlight is that it would actually potentially be an inconsistency in principle. So respondents that didn't agree generally acknowledged that mirroring the distinction in revenue is sensible, but it didn't necessarily achieve consistency in accounting principles. They emphasized that this potentially artificial and yet very precise distinction actually becomes critical to applying the accounting guidance, and the currently proposed distinction may actually lead to inconsistent principles being applied to transfer expense transactions. The last key issue noted by constituents that we wanted to flag was the difficulty in practice. The distinction was considered complex and difficult to achieve in practice because of the administrative burden, and I remember one constituent actually noted that it was just very overcomplicated. All in all, it meant that the complexity didn't necessarily provide useful and relevant information, and therefore the costs of being able to apply the guidance and apply the distinction may not necessarily justify the benefits that it would provide. Now, when staff stepped back and considered this feedback, and we thought about what it meant overall, it was clear that the transfer provider's correct analysis and identification of the transfer recipient's stated obligations is integral to the correct application of the proposed accounting guidance, because the distinction determined the actual recognition and measurement guidance that would then be applied to the transaction. And this was really a trickle impact because concerns about this distinction reasonably overlapped with concerns that these constituents raised on other proposals within 8072. The issue with the distinction creates problems and consequences in different ways. So for example, the difficulty monitoring the satisfaction of transfer recipients' performance obligations, as Paul previewed in the earlier discussion and as noted by some of the members in the following discussion. And this is because of a lack of data, sometimes the practicality of monitoring, and potentially this could lead to selective accounting decisions by an entity to achieve desired outcomes. Another trickle impact is that the different accounting under transfer expenses without performance obligations just didn't sit right with the constituents that disagreed. So for example, constituents that disagree with the proposal to distinguish also disagree with the recognition proposals in 8072, where you would defer the recognition of an expense where the transfer recipient has a performance obligation, but you would actually recognize an expense immediately when the transfer recipient does not have a performance obligation, irrespective of whether the transfer recipient has a present obligation from a binding arrangement. Lastly, the concerns about the distinction reasonably overlap with concerns about the practical difficulties with applying the PSPOA model. Now, considering these comments holistically, staff note that the concerns on the distinction can trace to one specific element. The guidance currently proposed in 8072 require the transfer provider, who's the entity actually applying the proposed transfer expense standard, to consider the transaction from the transfer recipient's perspective rather than from their own transfer provider perspective. Now, we presented this item to the CAG in June, and we were happy to have their time and input into it because they provided a lot of great advice, which I want to provide a quick summary for here before passing it over to Thomas for any additional comments. I would say overall, the CAG members unanimously supported staff's identified root cause and the proposal to change the perspective used when evaluating these transactions. There are 4 key pieces of advice that we wanted to highlight for the IPSASB today. Several members had noted that it is important to remember who is actually going to apply the transfer expense standard. The proposed accounting guidance should be helpful and feasible and practical for the entity applying it, and thus it would be more appropriate to propose guidance to require the transfer provider to consider the transaction from its own perspective. Another key piece of advice from some of the members is that this is a reminder that changing the perspective is really a starting point to address the comments overall received in response to 8072 and the various issues that have been noted. The first is to first determine whether retaining the distinction from a transfer provider perspective is useful, which is what we'll be doing today, and then to consider the implications on recognition and measurement principles in the proposed accounting models, as well as we mentioned earlier in our conversations, the monitoring component as well. And by following the sequence, we'll be able to better build towards getting the right accounting model into the final transfer expense standard. A third key piece of advice is to be deliberate in choosing when to have consistency in principle between the revenue project and the transfer expense project. For example, in April, the board had made a decision that the enforceability of a binding arrangement and the concept of a binding arrangement is equally fundamental for both. And the IPSASB should continue to critically assess these decisions in the way that they have to ensure that there is no blind mirroring, if you will, and that any decision on consistency is assessed appropriately and considered before making the decision. The last key member advice I wanted to note was that some members also emphasized the need to continue considering the feasibility and practical implications, such as on the implementation and consolidation considerations for transfer expense accounting, and to also consider whether a separate PSPOA model for a small subset of transactions in the public sector is still sensible to actually retain. So I'll take a pause here and take down the slide and pass it to Thomas for any additional comments he would like to make on the KEG session from June and any feedback from members that you'd like to emphasize or that I have missed.
Yeah, thanks, Eileen. We agreed on that approach up front, and as expected, you summarized it perfectly. I think you didn't miss any point, but nevertheless, let me just flesh out a little bit more what we have discussed, because indeed it was a very rich and very complex discussion, as you can imagine, given the topic. Just starting with the feasibility and practicality aspect, I think members really emphasized that these are very important attributes for the standard, and they are definitely increased by changing the perspective to the transfer provider, as he is the preparer. And focusing on the perspective of the transfer provider is especially helpful because it is the transfer provider in the end who controls the process, from defining the detailed regulations within the arrangement, monitoring the process, and discharging and approval process. So that's definitely helpful, and it increases feasibility and practicality from the preparer, in that sense, the transfer provider as well. In that regard, and in that context, we discussed as well that there is an important aspect about how politicians could control the correct application of the rules, and by that, the correct use of the funds provided. And there was Ian as the board chair who responded that the standard will address the aspect of appropriations and its consequences for accounting as well in this context. And the European Commission was explicitly concerned regarding remaining control on the asset, which helps then politicians safeguarding the intended use of the funds. So that's one aspect regarding feasibility and practicality. You mentioned correctly the word starting point. I think the emphasis laid on the word only. I think the CAG was very content to see that this is used as a starting point, the change of the perspective, but they kind of emphasized this is only the starting point, and you highlighted it because a lot of consequential discussions are related to that. And one, I think you already discussed, one example which was brought up in the CAG discussion was, if there is a performance obligation, how to ensure that the transfer provider is getting the full value from the funds provided. I think that's leading back to the discussion we had earlier. So CAC members were content to hear that board sees that only as a starting point and further considerations will follow. In the context of the 5-step approach, I think there was some discussion about, is the differentiation between present obligation and performance obligation really needed for transfer expenses? It was also questioned, and therefore I think CAC members will be very happy to read the papers and to follow the discussion. Because from the CAC perspective, I think that is going in the right direction. It was also emphasized, as Eileen rightly summarized already, that from the CAC perspective, the majority of transactions are without performance obligations. And therefore, it really is questionable whether it makes sense to define a known approach for the remaining small group of transactions. In regard of mirroring, the question was discussed whether it could happen that the transfer provider and the transfer recipient account differently for the same transaction. And there was like a sense or an assumption that the transfer provider probably could recognize an expense earlier than the transfer recipient would recognize a revenue. So given that both could be within the same consolidation parameter, the question was discussed to what extent that aspect would require stronger emphasis on consistency for both revenue and expenses. But in that context, members were of the view that avoiding elimination difference by mirroring has some merits, but that but on the other side, mirroring is not a goal in itself. It shouldn't be kind of like followed as a principle or an objective in itself. So there could be a trade-off between what is done at entity level and what is done at group level when doing the consolidation. And last but not least, with regards to binding arrangement, there was agreement that this is an important instrument to ensure consistency in application of the guidance. But the main aspect focus has to lay on enforceability. I think that is reflected in the papers as well, very well. The only aspect which was brought up here, probably of interest for the board additionally, was from a developing country's perspective, where enforceability is often not existing, regardless what is written in binding arrangements. So that was more a practicality aspect in applying the principles. But overall, thank you, Eileen. I think you summarized it quite well, and it has been reflected in the papers very well. Thank you.
Thank you, Thomas, for that summary. So if we can just move forward through to the recommendation, Eileen, and then we'll open up the board discussion.
Thanks, Ian. Just wanted to quickly show this slide as it does connect with the recommendation that we have, because essentially for the transfer provider, we had assessed that the key consideration for the accounting for a transfer provider is actually whether there is or is not an asset for that. If the right gives rise to an asset, whereas on the obligation side, it does differ from what a transfer recipient would see from the transaction, where the transfer provider's perspective would be about whether or not they have this obligation to transfer funds to the transfer recipient. And so the recommendation that we've proposed in the paper is to remove the distinction between transfer expenses with performance obligations and transfer expenses without performance obligations, because the analysis in the paper, as well as the discussion we've now had with the constituent comments, as well as the CAG feedback, has indicated that it is likely not useful for the transfer provider perspective. So we'd be happy to open up for comments now to discuss this item.
Thanks, Eileen. So comments from board members on that recommendation. Ross.
Just to feed in Hervé Adrian's comments that he provided, he was in agreement with the staff proposals.
Thanks, Ross. So I'm not seeing any hands raised. So I think we're in agreement with that recommendation. So if you can move us on to the next recommendation, Eileen.
I realized myself was muted. I'm glad Zoom told me that. Sorry about that. The second recommendation in the paper is that now that we have made the decision to remove the distinction between transfer expenses with and without performance obligations, it points to the next step of revising the proposed guidance and reconsidering the proposed accounting models to better capture the nature and the substance of the transactions for the transfer provider. Now, as we have alluded to a little bit already in our discussions today, as well as a little bit yesterday, there is a continued impact from there, because once we have assessed what revisions we need to make to the accounting models, we'll also need to consider the monitoring aspect and some of these other comments that we have received from constituents. So again, it's a process, but we felt that this was going to be the primary next step now that we have decided to remove the distinction. So we'd be happy to get member comments on whether this approach makes sense, and if there's any additional considerations you think staff should keep in mind as we proceed.
Thanks, Eileen. No, I think we're all content with that approach. Todd?
I'll just make a few comments. I think that is the logical next step, and I think through some of the discussions we've had through this agenda item, there is a bit of stuff to think through as we develop up what is likely to be a different model to what was proposed in the exposure draft. But definitely the right next step, and look forward to getting some papers as thinking develops in that space as to how this will play out. I still, as we have discussed, I still think that the bulk of the transactions in this that'll be covered by the standard are going to be expensed immediately, and so we are dealing in coming up with this model with a very small minority of the transactions. So it is worth just keeping that perspective as we work through this.
Thanks, Todd. David.
Thank you, Ian. I don't know whether this is the right place to raise it or not, but I'm sure 4.2.4, the paper we're on now, was mentioned yesterday in reference to various questions that members raised about the measurement of an asset. Now, I don't know whether we're discussing that today or whether that's going to come through in the next set of papers, but I mean, obviously it is extremely important that we bottom that one out, certainly in the context of whether or not the transfer provider does control an asset, and if the entity does control an asset, what is the asset that it controls?
Thanks, David. Eileen, do you want to pick that one up?
Yeah, David, you definitely got it right. We will be adding that into part of the proposal on the accounting model itself as we are assessing it. We just wanted to make sure we're taking the steps first to, get the agreement that we should remove this distinction, and that there clearly are a lot of reasons coming from today's session overall across the papers that point to things we need to reconsider when we're putting together this newer revised accounting model moving forward. But absolutely, we will be bringing something back at the next session.
Okay, thanks for that confirmation, Eileen. Okay, so I think therefore we're content to move forward as proposed by staff, and obviously, as said, there are a number of issues that we're going to face on that. Renee.
Yes, thank you, Chair. I am comfortable with the position. I just wanted to clarify, will this decision here potentially have other trickling impact on other topics that we discussed earlier today? So for example, when we just discussed with Paul the revised guidance on onerous contract, for the transfer provider to do the accounting that is now reflected in the revised guidance for onerous contract, the provider would need to look to the recipient's fair value of their own services or their own goods. But here we're saying that we will take a perspective of a transferor, and we want to recognize the substance of the transfer from the perspective of from their perspective. So is it possible that as we further advance the thinking here, that we would go back, for example, I'm just using an example because it's the one that's fresh in my mind about onerous contract, for example. I'm just trying to clarify potential impact on what we just discussed earlier this morning. Thank you.
So just to clarify, we're not going to use the term onerous contract in terms of this standard. And I think that deals with the sort of issue that you've raised, Renee, which is actually how does the transferor see this transaction? And they've got to account for it in terms of the way that they see this. I think the point that David raised is relevant here because we clearly need to have a look at what's actually the nature of the asset going forwards. And what are the measurement issues, but again, from the transferor perspective, because if you look at the practicality issues that constituents have raised, clearly they don't have access to that information in terms of the transferee's books. So you can only account from that perspective. But I think it also picks up the points that Thomas was making and that we also made in earlier meetings, that in terms of consistency or rather in terms of coherence of the accounting on the expense and the revenue side, the construct needs to be consistent between the guidance. How it's applied in the context of either the transferor and transferee is between the preparer and their auditors, but our guidance needs to be consistent in terms of how you would approach those decisions, because it is possible that there are circumstances where, given the different perspectives, given the same guidance, you might arrive at different answers in terms of the accounting, but that's an entity debate, it's not a guidance debate, if that makes sense. Paul, you wanted to come in?
Yeah, just to say, I think when we were in the draft guidance on sort of the expected deficits, it was talking about the fair value from the transfer provider's perspective, not the transfer recipients. But I think given the discussion we had, I think we need to look at a much wider subsequent measurement issue rather than being narrow. So I think, yes, I think we can probably expect to see this guidance change based on the discussions we had with the board earlier.
Patricia, I don't want to get into prefacing what we're going to discuss in measurement, by the way. I just want to get confirmation about the recommended way forward. Patricia.
Yes, sorry, yeah, but I'm confusing with the not to consider honest contract, because before we decide use the principles of executory contracts. In these principles, I need to consider owner's contract. I'm confused about the.
Just see what, can we not get ahead of staff? If you can allow staff to bring that back, we also have a further discussion to have about whether we use the principles of onerous contract or executory contracts and so on. So can you hold your points until we've actually got staff's response to the points that have already been raised? And then we'll have, then we'll have the debate at that stage rather than on hypotheticals at this stage. Okay.
Okay.
Right.
Thank you.
Okay. So Eileen, anything else on this item, or do we move on to 4.2.5?
No, thanks everyone for your comments and your support on the recommendation. So I think it really points to the importance of the papers we'll be bringing next time round in further addressing the principles in the standard. So I'm happy to move on to the last section, if you will, of the revenue and transfer expense agenda item. And it's composed of 2 papers, and they're really focused on how we are going to be drafting the final pronouncements and the work that staff have been doing over the last quarter and will continue to do as we draft and incorporate guidance based on board decisions to date. So I'm just going to quickly share my screen here and move on to paper number 5. So 4.2.5 was related to the establishment of a drafting group. The board had previously instructed staff to consider the need, the role, and the composition of a potential task group of sorts for the projects themselves. Now, both projects are in pronouncement development stage, and so staff and the IPSASB chair have developed a formal drafting group for this current stage of both projects, which will help provide support to the IPSASB in finalizing the pronouncements. Now, the overall purpose, which I've summarized here on the slide, is intended to support an action incorporating the IPSASB decisions into the drafting overall, to perform the detailed review of this drafting, to make sure decisions are appropriately reflected, and to flag any drafting issues that will require further IPSASB input. Now, we want to emphasize here that the drafting group will not be reopening any decisions that have already been made by the IPSASB at this time, or decisions that were made leading up to the exposure drafts, which were not challenged by the constituents, i.e. they were already supported by the respondents to the EDs. Now, the creation of this drafting group will allow the IPSASB to focus the board sessions on principle-related issues and ensure that the decisions are appropriately and consistently incorporated into the final standards, and also to focus the shorter plenary time as a result of this virtual environment on the issues that really do need additional member feedback. Now, the composition of the drafting group is made up of 6 members, and here I'd like to extend my thanks to these members for agreeing to be part of the drafting group, as we know it does take additional time as well, but we definitely appreciate the support, and it will ensure that we incorporate the board decisions in the right way, clearly and consistently, into the final pronouncements. So the question we had for the IPSASB was whether members agree to delegate the detailed review of guidance in the draft pronouncements to the drafting group based on the decisions of the board made on both projects.
Thanks, Eileen. Questions and comments from board members? Seeing any hands raised, so I think the board is content with that approach. Good, okay. See thumbs up on that from various members. So takes on to the final paper for the session.
Okay, thank you. So the last paper summarized some of the changes as well as the content and the structure of the draft IPSAS that staff have been working on over the last quarter. There has been significant process in reviewing the responses by the board and discussing these key principle related issues. And we've had several really great decisions that have come out of these discussions in both the revenue and the transfer expense projects. Now, some of the key things we wanted to highlight here was the decision on emphasizing the prevalence of transaction types in the public sector, that the concept of a binding arrangement remains fundamental for both revenue and transfer expenses, the need to clearly communicate scope and key accounting principles associated with the accounting for both types of transactions, and also the additional and helpful CAG member advice that has encouraged the IPSASB to consider public sector perspectives and user needs in revising the presentation and, of course, the ordering of the accounting guidance. Now, staff have taken these into consideration when drafting the IPSAS, and the overall structure has changed since the exposure draft to better communicate the accounting principles and better reflect the nature of guidance based on the feedback and the IPSASB decisions on principle-related issues made to date. The key change is actually the moving up of the assessment of whether there is or is not a binding arrangement. So the guidance will now first ask the entity to identify if the revenue or transfer expense arises from transactions without or with a binding arrangement. This is because in both March and April, the board had identified that binding arrangements is a fundamental decision point to ensure they understand the nature of the transaction and therefore apply the appropriate accounting. Now, as we summarize on the slide here, the constituent comments that we've received and a lot of the discussions we've had today has really, not today, just this year, since receiving the responses to the ED has been focused on transactions that are with binding arrangements, because there haven't been too many comments from constituents about transactions without binding arrangements, where there is a majority of public sector transactions. So we have revised the overall structure and presentation of the guidance to bring guidance on transactions without binding arrangements first, before then transitioning to guidance with binding arrangements. And we did so in both the draft IPSAS for revenue based on ED 71 at this time, as well as the draft IPSAS based on ED 72. Now, we have proposed this revised structure to the drafting group during our August session, and we did receive support for this change, but we wanted to propose this here to the board today, just to make an opportunity for the board as well to give any additional thoughts or considerations, whether your agreement or anything else that you would like to mention at this time, for staff and the drafting group to consider as we move forward with the ongoing drafting of these final pronouncements.
Thanks, Eileen. So up for any member comments on that, bringing binding arrangements up front. David.
Thank you, Ian. It makes sense. What concerns me, I think, from a preparer's point of view, would be that the standard is easy to follow. So I can see why, you know, one standard on revenue and one standard on transfer expenses, I think, is logical, because I, as a preparer, I would know I'd got some revenue, or I think I've got some revenue, so I go to one standard. I think if the standard then tells me right at the start, I need to consider whether I've got a binding arrangement or a non-binding arrangement, that's good. But then I need to know where to look. I think from a preparer, I do not then want to have to go through lots of different paragraphs looking to see whether that paragraph deals with binding arrangements and this with non-binding arrangements. So it's got to be easy for a preparer to follow. I mean, let's be honest, it's not going to be a short standard. So therefore, signposting, anything to help somebody get through it, or even one section on binding and one section on non-binding, I don't know, but I think the drafting group and staff are going to have to take, you know, think about that very, very carefully as they produce the goods.
Thanks, David. So I'm just going to take comments at this stage, but I see support for that need for clarity. Mike, and then Adrian.
Thanks, Chair. So I'm very happy with what's being proposed. I was trying to read Appendix 1, which it is clear to me now that it's all about what's currently in ED 71. So I'm assuming the fact that there isn't a line in the recognition dot points that deals with recognition of revenue arising from transactions with a binding arrangement where there is a performance obligation, because that's going to end up in ED 70. Is that right?
Ian, would you like me to respond first to that?
I think let's just take the other comments, if that's okay, because I think, Mike, there is still an unresolved question around exactly how many standards we have and where. Okay. So I think at this stage it's actually hard to answer the specific.
Yeah, I understand that. I think you're right. So, but then I suppose I don't want to sign off on those two appendices until I've seen the third appendix, or until we've made that decision. Yeah.
Well, can we just focus on, is it right to have the question about binding arrangement or not up front, rather than what comes after that? Adrienne.
So this is really just to congratulate staff on making these changes. I mean, as you all remember, this has been my frustration from the beginning, and I think this is a quantum leap towards a clearer approach. So thank you very much to staff, and obviously I support this. I do echo what David said on clarity will be very important, and the drafting group in that sense will be will be very important. People need to know how to find what they want within the standard. But having said that, I think this is a massive improvement on where we were. So thank you very much for listening. Thank you.
Thanks, Adrian. Lynn.
So to answer the question about bringing the discussion on binding arrangements up to the front, I think that's helpful and important. Like David has said, it's important to signpost it. You know that I'm firmly of the view that we should be having one revenue standard, not least because performance obligations are a subset of present obligations. So they are a subset of revenue from binding arrangements. And so having this delineation, I suddenly have to then go to another standard. That signposting is going to be crucial, but I think in a couple of the discussions today, we shouldn't lose sight that revenue with performance obligations is a more precise form of revenue from a binding arrangement. It's a subset, and it does seem to me to be pulling out a separate standard on a subset still doesn't make sense. If we are going to do that, we have to be very careful with the signposting, because we'll end up with, when am I in this standard, when am I not? And that's not going to be helpful to our constituents.
Thanks, Lynn. Todd?
Yeah, yourself, my thumb up, I think, when Lynn was speaking. I think it's going to be really important from the drafting group's perspective to land the issue of whether we are going to have one or two revenue standards. And I don't know, whether we can try and bring that one to a head maybe at our check-in or sooner rather than later, because I think we'd tentatively said we're still going to have two standards here, but we would need to revisit that at some point. And I'm just wondering whether we can bring that decision a little bit forward, because I think it will help from a drafting perspective, rather than making that decision later, particularly if we then decide that we just want one standard. There'll be quite a bit of work to do in that space to make it one standard. So I would be very supportive of us having the conversation about one or two standards sooner rather than later. It doesn't have to be now, because we probably would want a paper to look at the pros and cons of it. But if we could perhaps do that at the check-in in October, or at the latest maybe December, that would help from a drafting group perspective.
Thanks, Todd. I agree. I think from the board point of view, we would need to have the decision supported by a paper from staff. I think you're right in making the comment that this is the stage at which there is a split in the road, and therefore from the point of view of developing the drafts, we do need to make that decision either in October or in December. And I think that's probably a question for staff to consider in terms of work involved and agenda time. But I think you're entirely right that for the drafting group to do its work, we as a board need to have settled our views on, one standard or two going forwards. Thomas.
Yeah, I don't want to kind of preclude the board's decision regarding one or two revenue standards, but just want to re-emphasize the recommendation the CAG made when it discussed the structure of the guidance overall, from an overall picture in December 2020, I guess it was, and the clear recommendation to be very clear in the communication for preparers when to be in what standard. And I think that's really, really important, and not only for preparers, but also for the understandability by users. This is relating back to the feasibility and practicality aspect I just mentioned before, and the understanding of politicians. So it's really important. I can just support what Lynn said. Thanks.
Thanks, Thomas. So I think we need to allow staff just to consider timing on that. But I think there's a clear instruction from the board that we need to be very clear, and we need to the signposting needs to be very clear in the structure or structures that are developed. but we will need to take that decision soon on the structure. Ross, I don't want to put you on the spot, so I think we need to leave it to staff to give us a recommendation on when we have that discussion, whether it's possible for the October check-in or whether it would have to wait until December.
I don't know if Ian, you want me to come back, but staff will take it away. I think that might be tough to get a recommendation from the drafting group for the check-in, because staff will need to do some analysis to make a proposal. But I'll take it away and discuss with staff and maybe update at the end of the meeting.
Okay, that's good. Thanks very much, Ross. Okay. Any other thoughts? So I think summarising that, I think I'm hearing strong support for members for moving that, whether there's a binding arrangement or not, decision right up front in the standard based on ED 71, and the instruction then that we need advice, further advice on one standard or two based on that decision or flowing from that decision. Anything else on structure that other comments at the moment? I mean, clearly this is contingent, but anything else that leaps out that you members want staff to consider in terms of developing the structures or structure going forwards? Okay. So I think that's good. So thanks everyone. A very useful discussion on that. Eileen, anything else you need from us at this stage?
Not at all. Thank you to everyone for your comments and discussion points over yesterday and today. They've all been very helpful for us. And as Ross said, we'll take this away and see what we can do for October and December to make sure we move these projects along. Thanks.
Okay, so I think with that, we thank both Eileen and Paul for the agenda material. I think that's helped us to move both projects forward a long way at this meeting. So well done on that. So we are slightly ahead of schedule at this stage. And I think based on that, we will then move over to starting the discussion on the leases item. So we'll just give staff a moment or two and we'll welcome Zhao to the table.
Yes, thank you, Ian, and good morning, good afternoon, and good evening to everyone. So as Ian said, we are in agenda item 6, leases. So I'll give a few seconds for the board to get their papers ready. I'll start over with those introduction materials about the decisions and instructions from the previous meeting, and ask the board whether they have any comments, and also allow Lynn as a task force chair to make some remarks over the progress made over the last quarter. So, and with this, Ian, I'll pass to you or Lynn. Thank you.
Oh, I was going to say, Lynn, if you want to make introductory remarks as chair of the yet to be formed task force.
So I was going to say, as chair of the yet to be formed task force, you'll see from the papers, we need to think about how we best use a task force on the project going forwards, and who will make up that task force. I guess it's just to remind the board that there are in effect 2 parallel projects that we are now doing: the alignment project on leases, which is the papers that you've got today, and also the second phase around the public sector specific issues. And I think it's going to be quite tricky for the board to navigate the papers we've got without opening up the whole phase 2 of the project. But I think it's really important for us to stay focused on landing the accounting model and the alignment, so that when we consider the public sector specific issues, we can do so with the certainty of the accounting model, which is an IFRS 16 based model, through the alignment project and through ED 75. So we've got a suite of papers here for today and for tomorrow. But I guess it's important for us to get sort of clarity to proceed, so that we can then move to start considering the phase 2 at the right point in time and bring those in once we've got certainty on phase 1. I think the other thing that I would just remind board of is that by moving forward to phase 1 and the alignment project, there's still a debate to be had about implementation dates. So it's not that we are going to implement something and then a couple of years down the line deal with the public sector issues. We've still got the opportunity to end up with a pronouncement that by the time it comes into implementation, we'll have dealt with the public sector issues. So I think that's important for us to remember as we're having the debate as well.
Thanks, Lynn, for that introduction. And I think, you know, in making that remark, actually, it reminds me very much of what we've done with financial instruments, where we've added the public sector specific issues, you know, and we're also locating in that standard the impairment material relating to financial instruments from IFRS 13. So I think that's helpful to keep that in our minds as we proceed. Okay, so thanks for the introductory remarks, Lynn. João, I think over to you.
Thanks, Ian. I'm going to share my screen now. So the first agenda item, it's related to the COVID-19 requirements. So agenda item 6.2.1, pages 5 to 7 of the PDF. And before entering into the specific item, I just want to make a generic comment that is related not only to this item, but also across the 4 comments and issues that I'm bringing to this session. So I just first want to highlight the board that there was overall support for the ED 75. So not only to the general accounting models for the lessee and lessor, but also across the majority of the issues that was proposed. But having said this, some respondents raised some minor points on ad hoc issues, and those minor points that staff is bringing as part of the due process of the review of the responses, but having this context of overall support of the ED, and how staff and the board can address those comments that have been received. So in this case, in the COVID-19 requirements, just a brief background, because of the pandemic, the IPSASB decided to make some changes to IFRS 16. We have introduced those changes into ED 75 because it was very timely according to our project development. But having done that, some respondents raised 2 broad comments. The first one is that the COVID-19 specific paragraphs are only related to this current pandemic, and some respondents suggested to make it a more generic paragraphs to be applicable to all pandemics, whether it is this COVID-19 or other types. On this specific issue, staff went back to the ISB's basis for conclusions to understand their discussions and the rationale. And as it is said in the issues paper, so the ISB's intention is that these specific paragraphs are only to be applied to the COVID-19 pandemic. They are not to be used going forward to all other pandemics. This means that these might be considered temporary paragraphs, because we don't know what the ISB will do in 3, 5, or 10 years' time with these paragraphs, whether they will continue or not, or if they will intend to change. So based on this, the staff recommends that not to touch these paragraphs, because the issues are not public sector specific that warrant departure from IFRS 16. The other issue related to this item is to change the limit date of the practical expedient. As it is said also in the issues paper, staff is proposing to have the very same date that currently exists in IFRS 16, which ISB also changed that date throughout the last year and a half. So once again, their intention is that to provide a single criterion and simple one to be applicable across all jurisdictions. So once again, the staff and the task force chair's view is that there is no public sector specific reason to change that criteria, and that warrants a departure from IFRS 16. So therefore, staff and the task force chair recommendation is to proceed with the ED75 proposals and include the specific COVID-19 requirements, but now referring to a specific date that it was left still blank at the ED, but now referring to June 30th, 2022. So, and with this, I'll pass over to Ian to receive feedback from the board. Thank you.
Thank you, João. Lynn, anything else you wanted to add before I open up to comments?
Clearly, if we approve this after that date or has an implementation after that date, then we will need to revisit this. So this is very much a holding position that we don't see the need to change the provision, but clearly we'll need to revisit that if it still makes sense in a final pronouncement, given the time of a final pronouncement.
Thanks, Lynn. So I've got Camira and then Lucy.
Thanks, Chair, and thanks, João, for the explanation. So when I first read this agenda item, agenda paper, and I thought about the date of June 30 and thinking about it in the context of our work program, and that we are planning first to publish the final pronouncement in June next year. I was thinking about how relevant could this date then be for us, and considering that when we in June we issue the final pronouncement, we will still give some years for, or at least some time. So is it really relevant for the to keep it in our case or not? But before I can make a final opinion on this, I would like to understand how important is this practical expedient, because from paragraph 48 I was not able to understand clearly. So perhaps if João could explain on that, because what it says is that basically it's the practical experience is that the lessee can account for any change in lease payments resulting from a concession in the same way it would account for a change applying the standard if the change were not a lease modification. But I was trying to find, okay, then which paragraph should the preparer use, or what is the difference, or how this practical expedient would benefit in practice the preparers. So based on that, we could then make a more informed decision of if we should maintain this practical expedient or not. So thanks.
Thanks, Camira. Good points. So just take comment from Lucy, and then João, I'll go back to you at that stage. Lucy.
Yeah, so thank you very much, Chair. Actually, I agree with the recommendation of the staff and the task force chairs to specify the applicability of practical expedient and which is consistent with IFRS 16, and this is June 30, 2022. However, I would like to emphasize that with the recent issuance of the IFRS 16 amendments, different bodies have issued or published several studies on interpreting and addressing various issues and concerns with the application of the practical expedient. Some of the concerns raised include treatment for deferred lease payments. The second is what is included in consideration for the purpose of purposes of paragraph 46B(a) of IFRS 16, and what is considered a substantive change to the other terms and conditions of the list. So in order to provide a uniform interpretation, I suggest that we provide further application guidance with respect to, but not limited to, the concerns that have been raised. Thank you, Chair.
Thanks, Lucy. So, Zhao, back to you.
Yes, thanks, Ian, and thanks to Camila and Lucy for those comments. Yes, staff has also reflected on some of those issues. So going to first to Camila's point about the relevance. So the relevance, even though we can see this in two ways. The first one is that even though this the standard might be published next year, and the effective and the date that the COVID requirements are also related to next year, it can be applicable to entities that early apply the standard, although the effective date might be 1 or 2 years time, or 3 or more. But for those that are still early applying in 2022, and also helps in the transition to move from the previous accounting under IPSAS 13 to the future IPSAS on leases. The second thing is that because of this, it doesn't preclude us to put the date there from that perspective. The other issue that Camila raised, which is more that from a technical side, the difference between this requirement and how does that impact in the application of the standard for those entities that elect to apply this, it's basically by saying that they don't need to count this as a lease modification, because if they need to count, because if they hadn't these paragraphs, the COVID paragraphs, they would have to go consider this as a lease modification, which is a more burdensome type of accounting, because then they need to assess the that transaction, allocate the consideration that they are still to be received, remeasure the lease liability accordingly. They have to also remeasure applying the discount to that liability, which is a much more burdensome type of accounting than, okay, no, you don't do nothing, don't do in terms of lease modification, and account as if it was always like this since the inception of the lease, which is much easier for the preparers. And that was, I would say, that the main reason that led IASB, and they were sensitive, because this was a call from their own constituents to ease these recalculations of the lease liabilities. Going to the Lucy's comments about the consideration, the substantive changes. Well, you are quite right. Staff also thought about this, and but the conclusion that I reached was that those considerations are not public sector specific. So this means that those doubts, those questions also arise in the private sector for entities in the private sector that are also applying IFRS 16. And because it's not public sector specific, staff thought that, okay, we don't have a reason to provide here a public sector specific example. But if the board feels strongly that there is any public sector specific, although staff has not yet identified, we still have the phase 2 of the project to bring in any, if and any amendments to bring those public sector specific issues related to consideration and substantive changes. I hope to have answered both comments. Thank you.
So thanks, Zhao, on that. So I go to Scott.
Yeah, thank you, Ian. I think I have a question or a comment. I know we're not the only standard setter that's considered this. I mean, I know FASB has as well. So I would suggest we'd be out of sync if we didn't include this compared to what the other standard setters are doing. And the fact that the other standard setters have means other people have implemented this before this. And so we know what the answer is because other organizations have already implemented this provision. And so I don't think we need to guess. There's evidence out there of how they've been able to do it.
Thanks, Scott. I think that's helpful. So I think with that, I'm not seeing any of the other hands raised. So I think we're content with the staff recommendation to retain those sections in the draft final standard. So move us on to the next issue, João.
Yes, thank you. So I'm going to share again the screen. So the second agenda item, 6.2.2, about the definition of a lease. So once again, there was overwhelming support for the definition of a lease that we have in ED 75, which is consistent with IFRS 16. But some respondents raised two minor points. The first one on what it is considered a consideration in the scope of that definition, and the other one about modifying the definition of a lease. So the first one on the consideration, some respondents raised the issue for us to provide additional application guidance or even changing the definition itself to consider nominal consideration or non-financial consideration. So this means consideration that it is not in the form of cash flows. So as it is said in the issues paper, ED 75 is very much designed for consideration in the form of cash flows. That's why we have all that guidance to make calculations about the discount, the present value of the future cash flows. So both ED 75 and IFRS 16 do not have any type of guidance to address when the consideration is other than cash flows being transferred from the lessee to the lessor. And also regarding the nominal consideration, so this is a topic that is very much associated with concessionary leases, and once again, as it is in the issues paper, concessionary leases will be addressed in the phase 2 of the leases project, and of course nominal consideration will be one of those topics to be addressed there. The other issue is to have a wording of control in the definition, so basically changing the definition of the lease by putting more wording into it. So staff once again went back to the IASB's basis conclusions to understand their rationale when developing that definition, and they addressed this issue, and they say basically that the application guidance is very much consistent with the definition of what it is in the definition of a lease. Staff has also the same conclusion, and so staff and task force shares for these two issues is that those issues are not public sector specific that warrant departure from IFRS 16, and that's why staff and the task force share recommendation to the board is to proceed with the proposed ED 75 definition of a lease. Because of the vast majority of respondents supported the definition of a lease, the respondents did not provide a public sector specific reason to modify that definition. It is beyond the scope of the phase 1 of the leases project, which is to be published in IFRS 16 aligned IPSASB, and of course phase 2 of the leases project will address concessionary leases and other arrangements similar to leases, if these is issues that are also raised at that point. And with this, I'll pass over to Ian and to receive feedback from the board. Thank you.
Thanks, João. Lynn, anything to add as Task Force Chair? Okay, so open up for comments from members. Yeah, Camira.
Thanks, Chair. Here, in the paper, I really like this association between the term consideration and also the term lease payments. Although this linkage is not, I could not find it in the text of the standard itself, because consideration could be broadly, also not only related to cash payments, but consideration can also be something in kind. And if some respondent is already flagging the issue that they have also these types of arrangements, I agree with the staff recommendation, but I do think that we should consider then this situation for phase 2 of the leases project, because maybe something public sector specific or yes. So thanks.
Thanks, Camira. Any other comments from board members? Yeah, Adrienne.
I'm not sure this is the right place to raise this, and I think it's something that you may not want to deal with here. I come back to David's emphasis on the need for clear signposting always, and I worry that how do we signal at this stage that there is another type of lease, concessional leases, that are not dealt with in this definition? I would have thought a very straightforward way of doing that is to include a definition of concessional leases in this phase 1 and say that they're not in scope. But I seem to understand from staff that that's not intended. So I wonder if that's the same question that Camaro was asking, but in a different way. Thank you.
I think it is a different question, actually, Adrienne, but perhaps I could go to João or Ross on handling this in terms of, because, you know, we're in the same situation as we are with the existing lease guidance, that there is no definition of concessionary leases, and what we don't want to do at this stage is you know, get ahead of looking at constituents' comments on the RFI. So I think there's a number of challenges there. I don't know, João or Ross, whether you want to come back on that. Ross, go ahead.
Yeah, I think there's a communications point we need to be clear on when we finalize the guidance for ED 75, that we're clear that there is the RFI and the consideration of further issues. On that particular point, Adrienne, if my memory serves me right, we explicitly discussed whether to have a scope exclusion included in the standard, and the board decided not to. So I don't think we should reopen that again. The board had a paper on that. We went through it. The decision was made. I think we need to reflect in the communications that there's 2 phases to this project and be clear to constituents how those 2 phases will work. So that's my initial response. I don't know, João, if you have anything you want to add to that.
No, I think Ross, though, it would be helpful actually, as we have done with previous projects, actually in moving towards finalisation of the aligned standard, if staff could bring proposals in terms of how this will be communicated, you know, both in terms of what's been done in terms of basis for conclusions and so on within the document, but also in terms of you know, the sort of wraparound, if I can call it that. Ross, back on.
Yeah, Ian, we've already been discussing this, and I think there's two key issues we need to flag in finalizing this standard. One, the link with the RFI and the phase 2 of the project, and also the link with the timing of the production of the revenue standards, because there's a link with revenue. So staff will bring back a paper with clear proposals on how both issues are handled in terms of the guidance itself, as well as communication on both points. So when we're in a position to approve this new guidance, that we're clear on how the further impact of other projects and the second phase of this project interact with it.
Okay, so I think we've got a clear instruction there. So thanks for raising the point, Adrian. Okay, any other comments on the recommendation from staff? No. Okay, so I think we're content to retain the existing definition. So move us on then, João.
Yes, thank you, Ian, and thanks to the board. So I'm going to share my screen once again. The third item is about discount rate. So agenda item 6.2.3, pages 12 to 14 of the PDF. So once again, this was an issue that the board discussed during the development of ED 75. So there is no new issues that the board didn't consider at that time, but still some respondents raised these three issues related to the discount rate, although there is overwhelming support for what we have in ED 75 from constituents. So the first one is difficulties in determining the implicit interest rate in a lease, difference between the real and nominal interest rate, especially in countries with high inflation, and also lack of guidance on the meaning of similar value in the definition of lessee's incremental borrowing rate. So overall, staff and task force share views that all these issues are not public sector specific, that warrant departure from IFRS 16. I would even say that the board even went as far as put some guidance, basic, that comes from the basis from conclusions from the ISB, also to help IPSASB's constituents on how to apply the discount rate. So, and with this, our recommendation to the board is that to proceed with the proposal in ED 75 and not to provide additional guidance on discount rate, because a lack of incremental borrowing rate is also prevalent in the private sector, and the IPSASB already clarified how to identify an appropriate incremental borrowing rate based on similar transactions in the basis for conclusions. And of course, real and nominal interest rate are not public sector specific, as is also a private sector issue also. So with this, I ask the board whether it agrees with the recommendation. Ian, over to you. Thank you.
Thank you, João. Lynn, anything to add at all?
No, only to say, well, discount rates has come up in discussion at IPSASB a few times about whether or not it's a public sector issue, and we're still to look at the RFI responses.
Okay, thanks, Lynn. I think that's a helpful reminder. Mark, go to you first.
I agree with the staff recommendation. I think there is no public sector specific issue on that. And at the same time, we have already public sector specific guidance in financial instruments on concessionary loans, which is principle based, where you also need to assess the borrowing rate or the risk rate. And I think this guidance works in practice, and therefore I would not deviate or change or add additional guidance.
Thanks, Mark. Lindy?
Thank you. And just looking at the BC, so I agree with the recommendation. I was just looking at the BCs. And kind of in two places we said it's not public sector is also issued in the private sector. And I wonder if we should just soften that a bit. Because I mean, obviously we've thought about it. We got comments again. I think we can say it once. But I wondered if we should say it the way we have here. We've like said it twice, and I guess we might just irritate our constituents if we say what we are here in this BC's paragraph. Thanks.
Thanks, Lindy. I think that's a good suggestion. So if you've got any sort of suggested wording that you want to pass over to João, just to help with that, that would be appreciated. Okay. Any other comments? Okay, so I think we're content with that recommendation. I'm conscious of the time in terms of coming up towards the end of the meeting, so I think we will hold over issue 4 until tomorrow. So we will start with issue 4 tomorrow. The other thing we would like to do tomorrow, just to be clear for board members, is obviously João has actually provided a proposed markup, a markup of proposed changes to ED 75, reflecting comments received, as well as having provided the draft basis for conclusions. So we want to make sure that we've walked through those changes, which will then set us up well in terms of moving towards clearance of the standards. So we want to do that tomorrow before we finish the item off. So just to be clear on that. So we'll do both those things tomorrow, and then obviously we'll move on to natural resources. Ross, anything else from your point of view administratively at this stage?
No, Ian, no additional points administratively from me today. Thanks.
Great. Okay. Well, we'll give you back 5 minutes then. So thanks everyone for good interventions today, some good discussions. I think we're moving well through the material and getting the debates and discussions we need. So well done. Look forward to seeing everybody again tomorrow. And bye for now.
Bye.